Good morning. Thank you all for coming. I am Sarah Williamson. I am the Chief Executive of Focusing Capital on the Long Term, our FCLT Global. So glad that you are here this morning to join us in a conversation with Carmine Di Sibio from EY and Paul Tudor Jones from Just Capital. So there has been a lot of conversation, both in the press and this week, about stakeholder capitalism, stakeholder, shareholder, all of these sorts of issues. And one of the important aspects of this is, how does the governance work? How does the governance work if you're going to think a little bit differently about who constituents are and how to best serve those constituents? So we're going to ground our conversation this morning in governance, tools for governance, and how that works. But we're going to talk about this concept of stakeholder, shareholder, and what does that really mean? So I'm going to give a quick introduction for what we do at Focusing Capital in the Long Term, just to give you some background, and then we'll jump into asking these guys questions. So we are a nonprofit, an NGO, a consortium of large asset owners like the Canada Pension Plan and the Government of Singapore, asset managers like BlackRock and Wellington, where I was for many years, and Schroders and Natixis and many others, and large companies like Unilever and Dow, and Carmine is on our board, and we are working on this issue of how do you rewire capital markets for long-term growth, which of course is very tied into this whole conversation about shareholders and stakeholders. So I'm going to spend a few minutes asking these guys questions. We'd like to open it up to the room and really make this a conversation. If you've got questions, you can start thinking about those and getting those ready. So there has been, I think, in the media and a lot of this framing, sort of a simplistic notion that it's shareholders versus stakeholders, that it's one or the other. I know that in a lot of the work that we've done, what we've seen is that the reaction to shareholders is really about a reaction to short-term shareholders. It's this idea that shareholders come into a company, they buy the stock, and then next week they demand that they change it in some fundamental way, and then they move on and leave it for others. So one of the things that we've been thinking about is how does time affect this? How do shareholders and stakeholders really converge? Do their needs converge over time? Or are there real trade-offs between shareholders and stakeholders? And so we're going to talk about how we can sort of flip that notion from versus to and. So, Carmine, let me start with you. Much of what EY has been doing recently, you've been pursuing a lot of work on metrics. And when it comes to governance, the way that most people govern organizations is they start with metrics. They look at metrics, what's measured it matters, all of those sorts of things. Can you talk a little bit about your thinking on this whole issue of metrics and how that can change the conversation around how somebody really governs a company?
Yeah. Well, thanks, Sarah, and thanks for having us here. Let me start with, I think a big breakthrough on this entire topic was the Business Roundtable, and all the companies. It was very U.S.-oriented, but I think that really has driven a lot of thought around this and some action, and we'll get to action in a second. But over 180 companies signed up for stakeholder versus shareholder, signed up for the new definition of a corporation, and literally signed something. And that might seem trivial to people, but that actually means a lot. And I do think some companies signed it and then went back and, in fact, I was talking to a few of them here, went back and all of a sudden they were getting calls from their board members saying, wait a second, what exactly did you sign? Where they thought it was something that was just part of the normal activity and normally in terms of what they do. So they had to explain themselves after they signed. But that was a start. And stakeholder around the different values, the long-term values, was important. But then, as you said, to drive this into action, to drive this into some type of governance so we can compare, you do get into this conversation around metrics. And you and I have been talking a lot about metrics. We've developed some metrics. We at EY were involved in a project called the Embankment Project, EPIC, that we developed some metrics there as well and developed a framework. There were 30 companies involved there, including asset owners, asset managers, corporates, and so forth. And that was a start as well. But I do think here in Davos at the IBC meeting yesterday, we, EY, as well as the other big four, have been working with WEF around metrics. And what we've done is, and we've each taken a section. We had the prosperity section, but there's human capital, there's governance as well, and sustainability. And we each took a section and really developed what we think are logical metrics. And what we've done is we've taken SASB, GRI, all the different alphabet soups, tried to distill them, and come up with 22 metrics. And in the meeting yesterday, in the IBC meeting with all the CEOs, there were maybe about 80, 90 CEOs in the meeting, I would say 2/3, and this was all electronic polling, so you never know who's really behind it. But I would say between 2/3 and 3/4 of the CEOs basically agreed to being part of this. Now that might change, but Sarah, it's a start. And I do think this concept of actually signing your name to these metrics, to the fact that you are going to disclose these metrics. The metrics are not perfect. There are no perfect metrics. Some are, some people feel some are more important than others. But again, we need to get started. And to me, a lot around Davos says there's a lot of talk, but not a lot of action. This would be action. And I do think it's important in terms of governance. It's important in terms of if we're going to move forward on this topic.
Great. So Paul, you've done at Just Capital a lot of metrics, a lot of polling, particularly in the US, and have talked about what you have found that people care about. And I think that has been very enlightening for people here in Davos and also other places where there's often this concept that the Europeans are way ahead on this, and the Europeans care about all these things, and the Americans don't. So maybe you could give sort of that perspective from your polling of the U.S. population.
Well, I think the most important thing to acknowledge is when the Business Roundtable came out and even talked about stakeholder capitalism, it was a real change from 1997 when up until that point in time, the business purpose of a company was to serve its shareholders. So the fact that we're even talking about that there are other stakeholders and now identifying who they are is a huge step forward, because up until certainly this past year, we had this myopic focus that the purpose of a company was to serve its shareholders, when in actuality you have 4 other important stakeholders. You've got employees, customers, communities, and the planet. And then you have government kind of acting as a referee above all of them. So now we know that the purpose of a company, if it's going to serve its and create and maximize long-term value, you have to look at these other 4 stakeholders. You cannot just look in isolation at shareholders and shareholder returns. So we poll the American public every year. We polled over 100,000 Americans, and they're going to come back and say to you, and we narrowed it down into 29 components, and the number one component to determine a just company, according to the American public, is what do you pay a fair wage? Number 2 is your company being led by someone with great ethics? Number 3 is, do you pay a living wage? Number 4 is, do you make socially beneficial and sustainable products? And number 5 gets back to benefits and worker treatments. So 3 of the top 5 metrics are around how you pay an employee and how you treat an employee. Interestingly, the 29th most or least important metric is shareholder returns. So if you ask the American public, what's the most important thing to determine whether a company is just or not, you're going to start and kind of end with how you take care of your employees, both financially as well as the significance, the respect, equal pay, treatment, opportunity, etc. And shareholder returns are at the bottom. And one of the reasons that we see this massive social disconnect and the divisiveness in the United States is because the C-suite is being managed according to 1997 Business Roundtable purpose, to serve its shareholders, where in actuality society wants something different. And the good news is that I think you can serve the other four stakeholders in the long run, maximize societal value as well as also maximize enterprise value, because companies that act in a more just way, if you look at our rankings, they on average tend to grow faster. They have more women on their boards. They employ 20%, or excuse me, they grow 20% per year, and they have a smaller environmental footprint, and they, most importantly, have a 6% higher ROE. So I think there's a way to grow the pie by taking care of other stakeholders and maximizing long-term value.
So I think here we've talked a lot about, if you have enough time, you grow the pie for everybody, it gets better for everybody. But there are real trade-offs, and obviously CEOs have to make real trade-offs every day. So, Paul, you said, for example, very high on your list was paying a good wage. Lower on the list was, I forget the exact term you will use, but basically the environment. Mm-hmm. So how do you think about the trade-offs among stakeholders? So, for example, transitioning to a different kind of energy will displace some workers, coal workers, for example, or investing in things that take a long time to come to fruition may depress profits and wages in the near term. So how do you think, what advice can you give to CEOs from your point of view as they have to make those short-term trade-offs that really will leave somebody a little bit unhappy in the near term at least?
Yeah. I don't think these are binary decisions. I think it's not black or white. I think it's shades of gray. Environmental sustainability, I think, was the fifth most important sixth most important subcomponent in our metrics according to the American public. So, and I think you've got to be able to touch them all in some form or fashion. I mean, again, I think part of the reason that we've gotten into a place of such social discontent in the United States is because, again, there's this massive disconnect on how the private sector's being run from the C-suite, which is primarily to serve the purposes of capital, both in the public sector and the private sector, versus what society wants, which is to acknowledge all these other things that are so important, as you mentioned, environmental sustainability, equal pay, equal opportunity, fair pay, living wages. And again, Carmine and I have been talking about this. If I had to pick the one metric that I wish companies would collect and publish, it would be, what is the wage that they pay by location? And the reason why that one's so important is if we look at our 1 in 3 metrics, which is fair pay and a living wage, what the American public's telling us is, let us know how you compensate your people. And it's really, really important that we know that by location, because if a living wage is important, and we know there's big disparity in cost of living around the country, then understanding whether there's a value proposition for a company to come to your community. If the jobs that they're bringing pay below a living wage, they actually become a tax on the community, because they're somewhere someone's going, and it's generally the government or it's local communities through either food stamps or the earned income tax credit or other governmental programs, is going to be making up that difference between a living wage and what it takes to subsist. So understanding how local company, or how companies, private and public, are paying their employees is really important for prospective employees, my children who are in their 20s. It's really important for communities as they set policy and depend on, am I going to give this particular company a tax break to come here? So as the IBC goes through its standards, if there's one, if I just look at what the public tells us, let's get very transparent. on wages. It's really, really important. And hopefully what a director of a board would say, they should ask their CEO, how many of our employees are not making, before we worry about dividend distribution or share buybacks, how many of our employees are not making a living wage? That, to me, that's the first and most important question a director on a board should ask.
You know, sorry, to add on to this, what Paul said is, you know, fair pay is incredibly important. It's obviously one of the metrics, and I agree with everything Paul has said. But there are, in terms of making trade-offs, so I would say today, and I'll use EY as an example, we hire 60,000 people worldwide all the time, and there are certain things that have become a basic that if we don't have and we don't believe in, I think pay almost doesn't matter, and that's having a purpose. Ours is building a better working world. If your company doesn't have a purpose today, I mean, I'm sure there'll be some amount of money that someone will come and work for you, but it will be huge. And so there's certain things, and I do think the environment is becoming like purpose. I'm not sure it's there yet, but and, you know, and we hire, the average age of our employees is 27. So the environment's become such a big issue with our employees that, again, it's become almost like, you know, the basics. And then you get into fair pay as well. Now that's a little bit different maybe for us than you know, blue collar workers somewhere making a living wage. But I do think as time goes along, these are the choices, to Paul's point, they're not binary. They're going to have to be worked together, and so it's not pay versus the environment, or it's going to be a balance.
Okay. And one of the things that we have talked a little bit about is the economy is strong in most parts of the world. The stock market's been basically on a bull run for the last 10 years.
The IMF wouldn't agree with you. But,
Okay, well, we could argue about that.
No.
But if we do have a serious recession or a major pullback in markets, how do you think these trade-offs change? And how do you think people think about either wages or protecting the stockholders through a downturn? And we've done, you know, some work on this in the past, and I think that, you know, what the research shows is that those companies that continue to invest in R&D and continue to invest through the downturn actually outperform in the long run. But in the middle of the downturn, they get hit harder. So their stock price gets hit more. So when a CEO says, if I do that, I will be punished in the short term, they're not crazy. So how do they make those trade-offs in a more difficult time?
You want me to take it?
Yeah,
So first of all, I do think there's a difference between a downturn and a crisis.
Yes.
You know, in a crisis, it's survival mode, and it's whatever you need to do to survive, and I do think some things will fall off the table for sure. In a more of a downturn, I do think it's important that everything we're talking about has a process, that it's ingrained in terms of what a company does, and so therefore it doesn't get shut off right away. The same way we're trying to make change now going in one direction, in a downturn we've got to make sure that change doesn't happen so fast in the wrong direction. And to me, that's important. Process, part of what a company is, part of what a company does, has to be part of it. So in a downturn, it doesn't go like that. And I you know, again, in a downturn, I think if we put the right processes in place, the right governance in place, these are sustainable actions for a company. In a crisis, to me, that's a different story because then you really are trying to survive. So in your example, I mean, some companies will get hit harder, but if they know that they're fine in terms of survival and so forth, it actually becomes the right time to reinvest.
Right. And what about from an investor's point of view? You see when the pressure is on, do you think the investment community will have a new attitude about some of these issues and kind of let it go through a maybe it's downturn versus crisis, or do you think that we'll sort of revert to our old habits?
Well, I think the beauty of stakeholder capitalism is that by definition, we say the business purpose of a company has 5 constituencies. So it's not just shareholders. So hopefully what we'll be doing beginning this year and going forward is recognizing that there are 5 constituencies. they all have equal importance in some way, shape, or form in this equation. So in the next downturn, rather than just thinking about, gee, I've got to look myopically, again, in very narrow lanes at just shareholders, I've got to think about for the long term. I've got to think about my employees and my customers and my local communities where we reside and we work and we act, as well as the planet. So that's, I think, the most exciting part about the new recognition that when you're running a company, it's not just about making money. There's a whole variety of human elements that are critical to the long-term success of both that company as well as society in general. So I'm very optimistic and very excited. Just the changing the language, just introducing this concept. When I think about the Russell 1000 companies and all those directors, they're going to walk in and they're going to have to say, okay, don't just tell me about how we're doing on an earnings basis. They're going to have to now, again, address these various constituencies. And again, number one question, how many of my employees don't make a living wage? Why do we have a business where we're conceivably garnering outsized profits if we have employees that aren't making a living wage? Let's examine that and let's think about that. And is that really the right the right thing ethically to be doing? So again, I'm very optimistic about the future.
Right. So we've talked a lot about things that we will do. So if we come back here in a year and we look back over all the conversations we've had this year, what do you think that we can point to that will be a tangible change, whether it's on wages or whether it's on being net zero carbon efficient, or whether it is on working with customers in a very different way? Some of you probably know, in Australia, there's been this Royal Commission that's looked very much at how people were treating their customers in the banking industry. What do you think, can I ask each of you to come back in a year, 2 or 3 things that you think we could really touch and feel that will be different?
Well, sorry, I would, this is supposed to be about governance, but we're moving talking a lot about, all
But this is governance, right?
Yeah, that's true. That's true. But I will tell you, very simple, if you take the IBC situation there, one simple thing to look at is how many companies have signed up.
Right.
And I mean, that's about as simple as it gets. And as far as I think this is my 6th or 7th time in Davos, I don't know that we've had something as concrete as that in terms of the next year. So if we do have traction there and if people are signing and so forth, that is something very much to look at. I think on the climate side, the other thing you could look at is how many more companies are signing up to carbon neutrality, how many more companies are really talking about this, what are the energy companies doing? There's a lot on the climate side. And the climate side has been taking up most of the conversation here in Davos, I would say, even though the other ones are just as important. I actually think human capital, pay is just as important as well, just hasn't gotten as much airtime.
I would say, and you're already seeing, I think, great signs in wage growth. So I'm going to look at U.S. wage growth. I'll look at global wage growth. We're already at the highest we've been in a decade. I hope that number goes higher, because it means that we're taking care of the people in the middle and the people at the bottom. So that's going to be, for me, the number one thing I'm going to look at to see how much this movement is impacting and driving real change at the business level. So, and I realize we've got a really strong economy because we've got so much global stimulation, fiscal and monetary standpoint, but I think also is just a general recognition that there has to be better sharing than we've been used to. I think it used to be, I do think it used to be shareholders versus the other stakeholders. That's why we went from 6% profit margins in 1970 to almost double that today, because I think shareholders did look at, or I think the mentality, again, purpose of business is serve its shareholders, was to look at them and to look at, it was kind of us versus them. Now I think it's everyone together, and I think that's going to, again, grow the pie, and we'll be better off at an individual level, both as employees, as shareholders, at a company level, and at a society level.
So let me see if there are any questions from the audience. Yes, please. I don't know, you need a mic? Yes, they're bringing a mic. Thank you.
Hi, my name is Judy O. I'm one of the global shapers at the World Economic Forum. And actually I have two questions, if we have time. One is, I've been to several sessions around stakeholder capitalism so far, and what I've heard from all the executives is that when it comes to the trade-offs between stakeholders, it depends. Nothing more than that. It just depends. So what is your recommendation for when you do make those tough choices and you have to do that? How transparent we should be about the choices that we're making and why we're making them? And so that's the first question, is around transparency to all your stakeholders around decision making. And the second thing is, as you create this governance standard and measurement, how are you including the stakeholders in that process? Do young people get a voice on how the company measurement will look like? Do labor unions get a choice in this? Do society get to talk and participate? And so just wanted to see what your thoughts on involving the stakeholders in the process of coming up with this metric and governance structure. Thank you.
So Carmine, maybe you could answer the metrics one, and then Paul, I'll ask you to answer the transparency one.
Yeah, so on the metrics one, I do think all the stakeholders need to be involved in the metrics for sure. Employees, obviously incredibly important, and obviously they have a voice. And if you look at the tech companies, in particular in the US, there's a lot of employee activism, and companies are changing because of employees, I would say. And actually that's a big driver. It's obviously a driver on wages, but it's also a big driver on climate. It's not an accident that a lot of the tech companies are at least somewhat ahead in terms of climate, because their employees are demanding it. So absolutely the different stakeholders are going to have to play a part of this. And I do think transparency is going to be important, and you get into metrics, and that's a way to show transparency.
And Paul, how do you see the transparency from the companies feeding back into sort of the way you see the reactions to those behaviors? Yeah.
Well, we started Just Capital because none of us were smart enough to know what the answers were. So we went and asked the American public. So all our metrics come from polling a perfectly demographic representative sample of the American public. And that's why I'm, in particular, focusing on wages, because that's always been that's always ranked so high on our list when we poll. Now this year is going to be really interesting. We'll be in the field probably in the next 4 to 6 weeks, and there's no doubt in my mind that environmental sustainability, which I think is 5th or 6th in our list, I'll bet you it moves up dramatically. If I think about how the dialogue on climate has changed in just the last 12 months, and certainly in my life, I've never seen anything like it. So I think what we're trying to do is to take what the American public tells us, I look at myself literally just as a journalist, and amplify that, and then try to drive policy changes such at the IBC. And again, hoping for transparency so that we can have the information to provide prospective employees and customers who buy products and communities who will be inviting companies to do business there. Let them have the information to make the decisions they want to about how they want to engage that company. And what I can tell you is the companies that act and resonate with what the American public thinks perform so much better on so many metrics. And the most important one is their return on equity is higher, their stock prices are up. We have an index so we rank 1,000 companies, and we have the top 100 companies we call the Just 100. Since we went live with that, their stock prices outperform the rest of the Russell 1000 by 6% over the course of the past 3 years, and it's reflective of their doing what the public wants them to do. And so I think that's That's really what we're trying to do, is give them a voice, give them a say in the boardroom, and transmitting to business leaders. This is what your constituency cares about. Get with them, and you're going to have a very successful business formula.
All right, one more question, and then we're going to be out of time. Yes, please.
Sarah, my question will be...
You've got a mic here.
Good morning. Michael Itz from the ICAW in the UK. I wonder whether or not we are getting any closer to having a common set of standards globally, rather than just by trading bloc or in major economy, because the way governance operates around the world is very different from North America to Europe to Asia. So just your thoughts on that?
I'll give a quick answer, see what you all think. I think that one of the reasons that having the IBC or the business community or the investment community, part of that is because, in fact, it's more global. So, and it can make those things more global. If I think about, our organization, it's very global. And we don't have to tell anybody in this room that different governments around the world have very different views on these things. So at least my opinion, I don't know what you all think, is that there is more ability for the business and the investment communities to get together because we operate so globally than trying to get a lot of governments to agree. But
Yeah, no, I agree with you, Sarah. I mean, the problem will be is if we're here 6 months from now and we still get the maybe thing and nothing's happened, I mean, you do get into, if a few major countries, if government did get involved on these metrics and really required them, that would be the spur that would push things ahead. I don't think that's happening. In particular, I don't think the U.S. is ready to do anything there. So I do think it's important that we do this ourselves, frankly.
okay. All right. Well, I'm getting the hook. So please join me in thanking Paul and Carmine, and thank you all for your participation and questions. So thank you both.
Thank you.